Option chains for selling put options is the topic of discussion for this video, my fine friends. At the 30-second mark of this video, a link will appear here to another video that will give you the unfair advantages of this strategy. Get ready, it's about to pop up. You don't have to click it right now, but just know it's there. Boom! There it is. 30-second mark. At the 1 minute mark, a different link is going to pop up to another video, I think a playlist right here of about 6 videos to help you get the ball rolling for yourself. Hey, it's not the be-all end-all. You are the be-all end-all, so you got to put the legwork in. Get ready, it's coming up. Boom! Okay, it's right there. Now let's start diving into this. In 2023 going forward, I believe if you have an internet connection, a bank account, and you spend money at least once a year, you have no legitimate reason not to be selling cash secured put options on stocks you'd be happy to own. Even if you're a master of butterflies, iron condors, all these other strategies, I don't really think you got a legitimate reason not to be selling cash secured put options on stocks you'd be happy to own, because you can build your own annuity. At some time in your life, your cognitive ability will decline and you will not be able to do the same sort of strategies because you won't be able to manage them. At that time, you could have built up a nice portfolio of dividend producing stocks, maybe sell some covered calls against them, maybe not. But when you're like 80, 90 years old and you just don't have the wits about you anymore, there's nothing wrong with just kicking back wherever you're kicking back and reaping the rewards of accumulated dividend stocks from selling put options. I got free stuff. I got paid stuff. The playlist right here, it was at the 1 minute mark. Watch the video that's at the 30-second mark so you can really understand why this strategy has an unfair advantage that other strategies don't. And boom, I gotta tell you this is not financial advice. Any ticker symbols that we use, which are the symbols for the different stocks, ETFs, whatever they might be, it's not financial advice. I'm not suggesting that you should take action on these things. They're just for demonstration, illustrative, educational, comical purposes only. That's it. You got to be able to figure out what is suitable for you. And if you go and watch this playlist that's at the 1 minute mark, it'll give you help in figuring out how to determine for yourself what's suitable for you. Because let's face it, my friends, I believe that it's best that you don't rely on the suspect opinion of other people. That's just what I think is good for all human beings across the whole earth. I think every human being, there's certain things that we as human beings, we should not rely on other people, and we should know for ourselves. You know, for example, your date of birth. You know, would you outsource that information? How about the proper spelling of your last name? Do you really need to outsource that information? Do you really need to contact an attorney to have that done for you? Probably not, right? So how about, being able to pick out a suitable stock for yourself? Do you really need to outsource that to somebody else that you just don't know if their opinion is in line with your best interest or not? And there's a lot of evidence to indicate that there's a lot of quote unquote, fiduciaries or financial advisor, financial whatever term you want to put on there, that their interest might not be aligned with yours. So that's something for you to consider. You make your decision on it. Last thing I want to tell you before we start looking at my paper trading account is I have success is pro paper trading. We stand, and we being me, myself, and I, stand with an affirmative view that you should simulated trade and you should practice. Doesn't mean you practice, all your life and you never take real trades, but it's there. It's a worthwhile endeavor. And please, don't fall victim to these hypocritical people that say paper trading is a waste of time because it doesn't have the real emotion. But yet, if they were going to, let's say they were going to be a firefighter, they would probably simulate fighting fires in non-real experiences, right? They would train in times when that real emotion wasn't there. So when they actually encountered the real thing, they could deal with the emotion and not have to worry about, is my helmet on properly, or things like that. So paper trading really gives you that. It allows you to figure out the little technical things of like, what is this and where do I click, and all these type of things that you will need to know. And then if you know those things, you learn those things when you don't have the stress of dealing with real money, then you don't have to be thinking like, oh, what is the difference of bid and ask? What was the delta again? Or how do I set up this? And how do I open an order? How do I close an order? You won't have to do that. You can just manage your emotions and manage the trade instead of figuring out how to use your brokerage account. So that's my suggestion to you with paper trading. This is a paper trading account. I want to be upfront about it because has been like since I've been doing this, that has been the topic that is over months. People put comments about paper trading, and to me, quite honestly, I think that's just like, you got one side of people, they sound like adults that are stuck in some sort of whiny baby syndrome, and the other side is pretending that they don't practice stuff. Like they go into competitive boxing matches without hitting a bag first. So to each their own. If that's how you handle your boxing career and how you handle your firefighting career, go for it. Right? This is your money. You lose money, you make money. Has no impact on how much food I buy. So let's get into it. This is an option chain right here. But I'm gonna pull this YouTube stunt on you before we get into looking at the option chain, which this video is about. We're gonna take a quick look at this position that I have here. I think on the last video, I had 100 shares of XLU that I sold I think I had a 68 strike price call, and I had this one. And my plan was if XLU started moving up to start compromising this strike price of $70, that I was going to buy 100 shares of XLU to turn this naked call into a covered call. If you don't understand what those terms are, then at the 1 minute mark of this video, there's that link to a playlist. Watch that playlist. It goes over a lot of terms and definitions and things like that. You still might need more education, but at least you can get the ball rolling that way. So they're like somewhat defined for you. And so what happened is XLU closed above 68, and those 100 shares got called away to the other person. So I bought them for 67, sold them for 68, made $100 because it was 100 shares, made $100 there, and then made the premium of the put option that I sold to get in, or how many ever times I did that, not sure. And then how many ever call options I sold to get away. So some people might say, well, you left money on the table. Yep, you're right. I'd rather leave money on the table than lose money. That's my opinion. You do your opinions however you want to do them, but that's how I'm doing mine. So what that has left me with here is now I definitely have a naked call still, and we're moving up. Right, the stock is at 68. Let's take a look at it on a chart. Right now we're looking at a 5-year. It's 5 years from left to right, and each of these red or green candles is representing 1 week. So we see it's kind of have this recently kind of doing this bottom of a range around 65 and top of a range of around 70. And we are starting to creep up towards that. I've got 25 days before I actually am before I'm really required to make sure I can deliver 100 shares. Of course, if XLU stays below 70. More than likely, I won't have to deliver 100 shares. But if it goes over 70 and on the 25th day, if it closes over 70, then I'm expected to deliver 100 shares. Now, technically, with American style options, I could be called to deliver those shares at any time in these 25 days. Technically, that's the way that it goes. But in a paper trading account, I don't know if that ever happens. And in my real trading account, it has never happened, but I've heard about it happening to people. So just for that little splitting hairs nuance there. So 25 days. So what I'm going to do, since what I'm going to do is I'm going to go to the handy dandy option chain. I'm going to look at this option for it has 4 days left to expiring close of business on July 28th. And what I'm going to do is I'm going to sell a 68 put option. And it's got a 40 delta, which means it's roughly has about a 40% chance of getting assigned. So one thing that is not super exciting about this particular underline is look at this bid-ask spread. Bid is what you sell at, ask is what you buy at. It's just not the most liquid. It's just not a lot of demand for these contracts. But nonetheless, I'll see if I can get filled in the middle. So I click on the bid. If you're having a hard time remembering, hey, which one do I sell and which one do I buy? You're going to sell the lower number. You're going to buy the higher number. And then what I'm going to do is see this slider right here, natural, mid. I'm sliding it to mid. Changing this over here to good till cancel. And I am putting it under long stock. I have this organized this way. If you don't want to organize yours that way, don't do it. If you want to, do it. Do whatever you like. All right, so now I got an order in the market, and we'll see if that gets filled. But if it doesn't, I still might have to buy 100 shares. If it does, I've got the money to buy 200 shares. So I feel like I'm managing this. I got plenty of time to position myself to be prepared in case XLU keeps going up and goes over 70. Now, what if it goes over 70 at like 25 days left to expiration? Let's say in this next week it goes over 70. And let's say as it gets closer to 70, as the stock price starts moving up to 70, let's say I buy 100 shares at $69. But then, so now I have 100 shares at 69, and let's say there's about 15 days left for this contract. And let's say the stock price starts dropping back down, and it becomes obvious that the XLU stock is going to be below $70 upon expiration date. Am I going to get stressed out? Do I feel like I made a bad decision? Do I go into panic mode? Do I feel like I'm losing money? Me personally, no. One reason why is that I'm not, if stocks start getting to be trading in prices where I'm not comfortable buying them, then I stop doing this strategy on them. I stick to the rule of buying, selling at strike price that I'm comfortable buying at. So even if I buy at 69 and it pulls back to whatever 65 or whatever, I really don't care, because sooner or later I think it's going to go back up. XLU, it's an ETF, can't go bankrupt, and it could put me underwater for a while. It does get a dividend. I don't really remember what the dividend is, but gives a dividend, and then I'll be selling call options against it. So I feel like I'm good. I'm 100% comfortable with any outcomes that can happen from what I'm doing here. So that's me. And as you learn to do the strategy more, you can tweak it to what you're comfortable with and to fit it into your personality type. All right, so that's our managing what's going on there. We're going to leave it at that for a moment and come into talking about the option chain. So on this Thinkorswim platform, it's under trade. See, this is option chain here. And even though there's a lot of different stuff going on, we'll just look at the basics. So right now we have a variety of dates. Right? And you see they're in this vertical alignment here. July 28, July 2023, right? 4 August, and it keeps going down. And then you'll see in parentheses this number. This number in parentheses is how many days until this expiration date. Me personally, I tend to look at this more, and if I need to, I'll start looking at the actual date, match it up with the calendar. But a lot of times I'm just looking at this, and I just really don't care. Sometimes I care, sometimes I don't. But by default, this is what I'm looking at. So let's open up this 25 days. You see going across this way, where we have some things, and you see that the screen is basically kind of cut in half here. You got calls on one side and puts on the other side. I can't quite remember if I've ever seen a brokerage account in the United States that had the puts on this side, or excuse me, the calls on the side and the puts on the side. From what I can recall of all the different brokerage accounts I've used, they were always on that side. But whatever, I mean, it should show you which one is call and which one's put. But so you just look for that. And then I have this layout. I have a custom. I customize it to have this information because this is the information that I like to look at, and we'll talk a little more about that in a second after we just talk about the general layout. All right, so we got calls on the side, puts on the side, and it's separated in the middle by the expiration date. Now, unlike right here, we see a bunch of different dates, right? But when we open this up, we're just going to see the same date here, right? If we open this one up, we see a different date, right? See how it ends? So we'll just close that. So you have the expiration date here. Expiration. Right now I'm showing all the strike prices. It's generally what I like to do, but I could change it to 4. Now we're only seeing 4 strike prices, right? 2 below, 2 above. But me personally, as I mentioned, I like to have all, and you play with it to see what you like. And then here we have the strike price. So the stock is currently trading closed last at 68.46 cents. And you see the option chain is showing us anything from 33 all the way up to 96. And right here, right, 68.46, 68, 69. So one side of this is black and one side is whatever color this is. And see how it's kitty corner? Black, black, this color, this color. The reason why that is going on is that the black is indicating out of the money. This color is indicating in the money. Now, if you're using a different brokerage account, maybe they're different colors, whatever. Just realize that they're probably going to be different colors, and when you're on the put side, as you go lower in numbers, it's out of the money. As you go higher in numbers, it's in the money. This color is in the money, this color is out of the money. And it's vice versa on the call side. As you go lower in numbers, you're in the money. As you go higher in numbers, you're out of the money. Then, well, generally, if you want to keep your life easy and trade the I have success formula, you're going to be selling out of the money options most of the time, maybe all the time, depending on your situation. So that's why over here I'm selling it's out of the money. It's like right at the money. I could sell the 68.50 if I wanted also, but just to try to keep it simple. It ends up being a little more, I guess, complicated and complex to start understanding what's the difference between selling an out of the money option and in the money option. I think if you want life to be easier, especially if you're a beginner, just stick with selling out of the money options. Once you got that down, you can kind of start learning about in the money options. But so that's what I got going on right here. And then if we look over here, I got this one sold, right, out of the money option. So that is the basic setup of an option chain. And whatever brokerage you're using, it's probably going to be somewhat similar. Whatever brokerage you're using, you might be able to customize the information that you see on the option chain. So for example, I like to see the bid and the ask. I don't really care to see the last. That's why I don't have it on there. So as I mentioned earlier, bid is the price that you sell at, and ask is the price that you buy at. If you're having a difficult time remembering that, just keep in mind that you're going to always sell the lower price and you buy the higher price. Now there's a caveat to that. As we saw with this one, if you say, hey Brent, you told me we always sell the lower price. This is the column that gives us information on selling. You can request anything. So right now, if I were to let's say if the market was open right at this moment, which it's 9:13 p.m. Hawaiian Standard Time. So, market hours, we're probably looking at, let me check for you, 3:13 a.m. Eastern Standard Time, right? So the market's not open. But if it was open right now, I would probably have a guaranteed fill of this order at $27. Mid, which if you remember, I took it to the mid, which is 50. So it's like in the middle between this bid and this ask. It's not a guarantee, but I might be able to do it. And then I could request anything. I could request 74, right? The further I request away from this number, the slower chance I'll probably have, or less likely chance I'll have at getting that filled. So I leave the bid and the ask on there. The reason why I have the delta is delta can be used for more than one thing. When it comes to selling options, what I like to use delta for, which is not the official, the primary use of delta, but kind of like a secondary, or maybe, is it thirdary? Definitely not the primary, but something that you can use delta for is just a general gauge of how likely your option will expire in the money. So it's not perfect. It is definitely not as accurate as if I would have a in the money column here. But I don't mind using delta, because if I'm going to be buying an option, there's a variety of other reasons why I would use delta too. But we're talking about selling cash secured put options. Delta gives me an idea of how likely or unlikely it is for a particular option to be in the money at expiration date, given the current information and current market, yada yada, all that stuff. So for example, we got a delta of 4 and 6 over here. So you got about a 4% chance, which would mean that you got a 96% chance that this is probably going to expire worthless. Right? 4% chance is going to that it's going to expire in the money. This one's 6% chance. This is a very low probability of expiring in the money. So conversely, it's a very high probability for this to expire worthless. Now, I also like to have open interest in volume. That gives me an idea of what's the demand for this type of this stock. So right here, maybe this one is for the day. So could be that we're over the weekend, that maybe it's resetting. Let's look at something that's a little more widely traded. And see if there's any difference. All right. So we see the numbers different, right? Much more open interest. So this lasts longer. When does this initially start? I'm not sure if it's like from contract not expiration, contract birth or whatever, contract inception, but it doesn't reset every day. So must be that this one is resetting every day. But with these two, it gives me a good idea of what's the demand, what's the liquidity for me to get in and out of here. And then I like to have the high and the low, and this will reset every day. So what I tend to do is I will look at, let's go back to this utility ETF since I have a position on that. So with this one, it's we already talked about why I'm putting this here, or why I'm selling, why I'm attempting to sell this option here, because this is one way that I would like to attempt to convert, my naked call into a covered call. All right, so that's why I have that. Now, what about, since I have money to buy the 100 shares here at $68, but I also have enough money to buy another couple hundred shares if I wanted to. So one thing that I could do is I think what's a good price that I would like to buy the stock at. Go to my chart and say, oh, down here 60. It's showing the $65 spot right here to generally seem to be a pretty good amount of support. It's been a pretty good support and even some resistance over here. So that's one thing that I could consider doing. Now, if this is my real money account, I'm going to do more than just look at that. I'm going to look at, especially if I'm not super familiar with the stock, I'm probably going to look at all these different windows and one by one and figure out, kind of tailor more. But for this, just looking at that weekly chart to get a general idea. So why don't I do that? I'll do $65. See if we can sell a $65 strike. We see the bid and the ask is 2 to 5 cents. Now remember, it's times 100 shares. One option contract controlling 100 shares. So it's this 2 to 5 cents times 100. So $2 to $5 before commission. Yeah, I get it. Like, you're probably saying, that's not exciting. There was a YouTube ad that said I can start traveling the world in 30 days. Buy their course, see how it works for you. But what you can do, you don't have to stick with this stock. There's other stocks. What was that? Forgot what delta that was. But look here, right here, close to at the money. Instead of getting $50, we're looking at getting about probably a little bit over $250 for 4 days. If you're going to do cash secured put options, multiply this number by 100. That's what you need in your account in order to have that cash secured. If you don't have that number in your account, then you're selling naked options and you're deviating from an easy, stress-free type of thing. You're moving into something else. But as we look down here, let's look at around the 10 delta. 9, 11, somewhere in here, right? So you could probably get somewhere between 30, 50 bucks, somewhere in here. Because as the stock moves up and down, these numbers are going to change. Look at down here around 5 delta, right? You're significantly away from the money. 5 delta, still getting, possibly if the stock dropped down a little bit, you might be able to get filled at 20 bucks, 25. Just try it. Try and see what happens. So my point is that some people, they're gonna get discouraged. They'll say, "Oh, it's only making X amount of money, right?" Well, depending on how much money you have in your account, maybe you want to sell some cash secured put options on Tesla. What we got over here, right at the money, getting around 550 bucks for 4 days. What do we got at 10 delta? Closer to 100. How about at 5? Look at that, around 40. So depending on which stock you're trading, the premium you get for the options could be significantly higher. Now, something like Tesla tends to look at this on oh, I don't have that set up there. Something like Tesla, let's see if we have it over here. Tesla, you have average true range per day of moving around a little bit over 11 bucks. Look at where is how about, let's put XLU in here real quick. Average true range of moving like $1. So what does that mean? It means you if you don't want to get assigned, or you want to get assigned, like the higher the number is in the average true range, means the more this is a lot of movement, back and forth. So these are things you want to take into consideration. Personally, if you're a beginner, I would focus on like good trade execution and sticking in your budget of what you can the type of stock that you have enough money to buy at least 100 shares versus and being less concerned about how much premium you're making in the beginning, right? Get some experience. You're going to start with your paper trading account, and then once you feel comfortable with it, you move into your real money account. I would consider be less concerned with how much money you're making and be more concerned with executing the strategy properly, so you're limiting your exposure to risk and you're mitigating any potential loss you could have. Pretty much everyone I know, including myself, whenever we've lost money, it has been from chasing premium, chasing returns versus having a sound plan and sticking to that plan, right? So maybe you have to nickel and dime it. Okay, so what was the point of all this? There was some point. I can't quite remember what it was. I think I'm going to I think it was selling an option. Oh yeah, 65 bucks. Okay, selling an option at 65. Now right now we don't have the high low, so I'm going to wing it here. What I'm going to do is what I will do. Let me take a look at that chart again. So the last couple days, all right, it bounced off the 65, pushing up to this 70, and these are two strong candles right in a row. This one really showing some strength, but let's see what's going to happen with that. And again, this is weekly. Let's take a look at the daily. All right, over the 200-day moving average, going into this resistance right in here though, and we got these kind of lows, but look at this kind of higher low, broke through this little resistance point here, moving into this resistance. So I'm gonna go with a 65, but just to see what happens. It's 4 days left to expiration on this, so basically July 28th, which should be Friday, right? I know it seems like 4 days should be 1, 2, 3, 4, but it's actually going to be 5 days of trading. So sometimes I forget to check this account until I'm making a video, but theoretically what I would do, I'm gonna put this order in, and then on Monday morning when I wake up, the market's already open, I'm gonna check to see if I got it filled. And then it'll have a high and a low number here for me. And then I'll start kind of, if I did not get filled, I'm gonna look at what the high, what the low is, and what it's currently trading at. And I'm gonna look at what kind of candle is forming here. Maybe look at the volume of it, which we see volume's been kind of increasing here. It's just money flowing into this for some reason. So then I can adjust. So right now I'm gonna go. Let's just go $7, I guess. So I'll raise this up $2 extra. See if I get filled. Putting this on long stock. And then tomorrow or whatever, see if I get filled. And then actually in my real account, that's what I would do. Is tomorrow I look at it. If I didn't get filled, I may adjust it, or I may leave it open. Let it be open Monday. I might also let it be open Tuesday. Then when I wake up on Tuesday, see what happens. So that's how I use the option chain for selling cash secured put options. I do the same thing on the call side, and I like it. I've put Theta in here before, and it didn't really help me out that much. Maybe I need to play with it more and figure out if I could understand it more. But so far, this having my option chain set up this way has been really, really wonderful for me, and where I can it doesn't like take too much room. The more data you put in here starts kind of squeezing, starts tightening up the stuff. As far as like, you got another row of information, starts tightening up all this. So if some things are nice to know, but not, I don't feel for my style essential, I probably won't put it in there, because if I get filled, I can put it in here. Like over here, I like to have quantity, how many contracts, how many shares, days to expiration, the price that I bought or sold the option at, or bought the stock at, or sold the stock, the mark, which is kind of like the market price, the middle price, something along those lines. I don't know what the Investopedia definition of mark is, but I leave it on there because even though I don't know the flippant definition, I know how to make it work. And it's basically letting me know that right now, if I wanted to close this out, I bought it for 26, I'd have to close it out for somewhere around 50, 59 probably, 58 and a half. And so that works for me. I put the delta on there. Not so much for this particular trade, but when I'm selling options in the futures market, I'm constantly monitoring the delta on that. For this, I don't really need to worry about the delta once I open the position, because there's only two things that are going to happen with this contract, with this particular trade for me. The first thing that could happen is this expires worthless and I just keep this $26. Or it does not expire worthless and I am going to deliver 100 shares of XLU to somebody at $70. So if the delta starts going up higher and higher and higher, which would mean XLU is getting closer and closer to 70, and then if it goes over 70, delta will I know it's a negative number right now, but I don't really look at the how I've been trading. I haven't really been looking at the positive or negative. I'm just watching the change of delta and where I'm starting from. So in this case, I'm not worried about delta. I might look at theta though. Theta is giving me an idea of every day that goes by, if everything remains the same, this contract loses about a little less than $2 of value. But not everything remains the same, because you got delta changing, you got Vega changing, you got the stock price changing. But it does give me an idea. Speaking of that, I have Vega here, volatility. This one I don't use as much, but I like it there just to kind of keep tabs on it. And then once my position's open, I like to have the probability of in the money, right? You see the delta is at 30.33, and probability of in the money is a little less, 28.74%. So delta, it's pretty accurate. It's not as accurate as this, but I don't feel that having that much more degree of accuracy is useful enough for me to add an extra column on my option chain when I can get pretty close right in here on the delta. That's how I like to do it. But of course, you can set it up any way you want. Now, these two, I don't think they give me an option to remove those. I think they're always there. So that is it, ladies and gentlemen, on a quick down and dirty, or a not so quick down and dirty, talking about option chain for selling cash secured put options on stocks that you would be happy to own if you got assigned. That's really the big thing, especially if you're somewhat new to this, especially, and even more, like if you're a frequent option trader already, you probably don't need to be as diligent about some of the stuff that I'm about to say. But if you're just generally new in general to the stock market, to trading options, then I would advise be highly diligent on first selecting an underlying asset, a stock, ticker symbol, ETF, whatever goofy name you want to use. Be very diligent on making sure that you have a minimum cash in your account to be able to purchase 100 shares of that underlying asset at the strike price that you're selling it at. If you were to say, well, Brent, I really want to sell it at 67.50, because I want to make this around 20 to 30 bucks, but I only got 6,500. Then you via like the I have success way of doing this strategy, you should know what the answer is. The answer is you're selling here. You want to make more money? Go out in time. All right, what could you get at 65 strike price when you're selling 25 days? Getting closer, right? What's the next thing? 32. 65 strike. Okay, you're around 20 to 30. Now you notice the delta went up because you got more time. When you're adding more time, it's possible the stock's going to move more. Now if you say, well, I don't want to sell out that far, blah, blah, blah. You know what? It's not Burger King. All right, Burger King, even though it's a restaurant, this whole idea of your way, right away, that's a farce. Right? If you're doing that, you more than likely are not going to trade in such a way where you are sleeping well and not stressing yourself out. So forget this your way, right away crap. Just stick with the rules to keep you, and they don't have to be my rules. Make up your own rules, whatever you want, dude. For dudettes, whatever pronouns we need nowadays. Whatever you want to do it. But this is my recommendation, especially for new people. Make sure you're selling strike prices, that you have the money in your account to cover that promise, that legal obligation you're making to the market. You sell a contract at $65, you're basically legally obligating yourself to buy 100 shares of XLU at $65. So you need $6,500 to do that. You can't do it with $2,000. Right? It's just pretty easy math. If you need help with math, there's a thing called a calculator. Grab one of those. Grab a pencil. Grab paper. Grab your 10 toes and your 10 fingers. Get an abacus if you want. Like, do whatever. In my opinion, it's not about appearing, looking smart, or trying to feel smart. It's about making money. So, F it. If you need to grab the abacus to do your math, do it. So, what else? So, all right, sell at those strike prices. Be selective on what stocks you're going to be selling put options on, because there's a chance you might own the stock for a long time. There's a chance. So So only sell cash secured put options on stocks that you're comfortable owning. Sell them at a price that you're comfortable buying at. Do not focus on how much premium you're bringing in. Don't let that be your decision. Pick a good stock that's suitable for you. And part of suitability, as I'm just like, keep pounding the drum on this one, is make sure you got enough money to buy at least 100 shares. And then I would recommend looking for stocks that have dividends. If the dividend is too high, and what's too high? Well, do a little bit of research online and figure that out for that particular stock in that industry. But if the dividend's too high, it could be a red flag, right? So just generally speaking, right, you're probably going to be, unless it's a sector like the REITs or some of the energy sector type of stocks and stuff. Generally speaking, very, very broad stroke here, right? Generally speaking, five, like, let's just kind of put a cap on, generally speaking, say a 5% dividend yield is probably like on the high end. Now, I own some stocks that are giving, actually I own one stock that's giving like around a 16% dividend yield. I didn't just buy that because it was 16% dividend yield. There's a little more to it that I felt comfortable getting this because of the sector it's in and a variety of other things. So there's definitely, it's not always a red flag if the dividend yield is high, but it could be. So what you want to do, if you want to go for the really high dividend stocks, you want to develop the ability to be able to tell, is it a red flag or not? Now, if you don't want to develop that ability, just stay with like 5% or lower. Just stay with 3% and like 3 to 5% or whatever it is you want to do. But that's going to be a key thing to keeping yourself out of trouble. Again, I'm going to reference watching that playlist at the 1 minute mark, because it goes over a lot of things. And I forgot about this one. Get this. Get these downloads, these free downloads. 1 or 2 of these will help you have a better idea of how to structure your mental framework for selecting suitable stocks for you to be doing this. With that, my wonderful friends out in YouTube land, I'm going to call it a night. And just in case this might ever come up at least one time on this video, on these videos that I'm making, I want to put it down for the record that I do not consider myself a YouTuber. I consider myself an investor. So I'm not so concerned about other things that YouTubers are concerned with. Video quality, mic quality, getting advertisements on this, getting endorsements and stuff. In fact, I've had 2 brokerages reach out to me that I'd never heard of, offer me some sort of deal. I never even, I looked into it just like a little bit, but I was like, I never even heard of these guys. So, my point is, don't confuse someone that is striving to increase their, like myself in this case, striving to be the best investor I can be, with someone that's trying to be the best YouTuber they could be. And the reason why I'm bringing this up, because my buddy is a real estate guy, and I watched one of his videos on YouTube, and somewhere in the comments they were making something like, oh, these YouTubers, blah, 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 blah. Like, and I was thinking, like, this guy's not a YouTuber. He's a real estate investor. So your comment is really like, it's kind of dumb. like he's not a YouTuber. I'm not a YouTuber. I'm an investor. So I hope you are an investor too. Aloha.